Everybody, how are you doing today? Looks like we got a couple of folks that have joined us already. Hope you're doing well. This is Shane and Jacob, and we're certainly glad to have you here. We're going to give it just a couple of minutes, let some more people fill into the room, and get going before we get going. But while you're watching, while you're waiting, first off, thank you for attending. I love seeing you here. We do have a guest book that we'd love for you to sign into. And then at the end, you can use that same guest book to provide any feedback. It's the QR code right up on top of the screen. It'll take you right there, sign in. And we're also going to have some drawings later on. So again, thanks for joining in, and we'll get started here in just a couple minutes when we get a few more people that have gotten into the room.
Yeah, thank you for attending. And please, yes, sign into that guest book using that QR code. We are also eager for your feedback and want to know how we can get better, because this is also part of it, is getting better at presenting this material.
Yeah, we're excited about this. We're first time we're using some new technology, at least new technology for Jacob and I. And it's broadcasting out to several different platforms. So we're getting to know this technology and this platform. So we're excited to have that going. And if there's any technical difficulties, just bear with us as we're kind of learning what we're doing with this new technology.
And please feel free to enter comments in your chat. We will get all those comments in our stream. We'll be able to answer those throughout the presentation. So, all right, I think we're ready. Shane, you ready?
Yeah, I think so. We got a few people on, so I think we can get going.
Sounds good. Well, thank you for coming to our presentation. This is now is the time to buy. With all of the negative things in the news, and rates going up and all the things that are supposed to scare us from buying a house, why is now the right time to buy? Well, we're going to tell you why. So this is our just our seminar on how to be a first-time home buyer, or even if you're not a first-time home buyer, this is just a great way to just kind of review the information. So who are we?
Well, I'm Shane Walmack. I'm a realtor for the last 5 years, servicing Dallas and now in Lubbock. I'm with Fathom Realty. Super excited to be on board with them, and looking forward to teaching and educating as much as we can on what it's like to kind of finagle your way through this market that we're in right now.
And I'm Jacob Foskey. I'm a mortgage loan officer with Nexa Mortgage. It's a wholesale brokerage, and we deal with about 180 different lenders, so we are able to shop on your behalf to find the best products and rates for you. I came out of an education background, which is why I love doing this. I just want to educate buyers on how to buy a new house. So
welcome. Thanks for joining.
Yeah, thank you for coming. All right, here's the first step. What do I do? Well, I put home buyers like, I don't even know where to start. Well, you need to talk to a mortgage loan officer, which would be me, right? So you talk to me, and we'll talk about some basic information. I'll get you to fill out an application, and then we'll talk about your the documentation that supports all that information. So I will help you verify some information on the back end, on my end. Once you've turned in your application, your documents, I go through and analyze your credit history, your income, the assets or your bank statements, your retirement, things like that, how much money you have to put cash down or cash to close, the liabilities or your debts, your work history. Most people want 2 years of solid work history. And then, of course, the same thing for housing history. We want to see that you have 2 years of housing payments on time, that you have no issues with your rent or a previous home. One thing on income that's important to note is a lot of people are like, well, I make this much income. Well, if it's like overtime or some other type of income that maybe not as regular, we have to look at it through what an underwriter would look like when they assess our risk with income, and actually use specific calculations based on how steady or how regular the income has been. That's called qualifying income, right? So that's what I'll do up front. And then take that information, and we answer these 3 questions. Am I, as a borrower, am I qualified? How much am I qualified to buy? How much of a house am I able to buy? And then which loan program? There's several loan programs out there that you may not know about, but conventional is one, FHA is another, VA for veterans, USDA for more rural areas, and then there's non-agency for special circumstances. We can go over those in depth on a one-on-one basis if you have more questions about those. But something I really want to talk about is the next stage, which is after we've gone over all of your information, and I've determined all those factors. I want to know, am I pre-qualified or am I pre-approved, right? And a lot of people want to know pre-approved. They're not the same thing. An important thing, especially for your realtor friends, for Shane, he wants to know, how strong of a buyer am I? Am I pre-qualified or am I pre-approved? And I'm going to give you, there's a little bit of disagreement about what the actual definition is, but I'll tell you what Jacob does to qualify you. So first of all, if I give you a pre-qualification letter, that means that I have looked at your application, I've processed your credit, and I've looked at your documents to verify everything that we've been talking about is going to be what an underwriter looks at. Then I run it through, typically through either Fannie Mae or Freddie Mac's underwriting system. It's an automated system that kind of analyzes your data, assesses your risk, and gives us some feedback. And then I can give you basically a pre-qualification as unofficial approval. I looked at it, I vetted it, and I've looked at it, taken it to an automated underwriter. Now, pre-approval means we take it to a step further and we submit it to an actual underwriter, a human being underwriter, who actually assesses your risk and will actually compare that to their guidelines. And then it also means documentation has been submitted to the underwriter, and it's more of an official approval. And so I highly recommend, if you're able to do this, it makes your offer look a lot stronger if you have a pre-approval as opposed to a pre-qualification.
Absolutely.
So that leads us to the most fun part. You don't want to talk to me, you want to talk to Shane.
Woo! All right, well, let's go shopping, guys. So as your realtor, which I really truly hope I am, some of the things that we're going to be talking about through the process is really determining the wants versus the needs. So what do you really want in a house, but what do you really need in a house? So that's going to be a big determining factor in where we're looking, how we're looking, and what's going to be important to you and your family. And that's all going to lead into finding the right house. So this is the fun part, right? It's stressful. We know that, but it can also be fun at the same time. And it should be, because this is going to be the biggest purchase of your life, for you and your family, or for you. And, so it's going to be a little bit of stress involved, but that's what we're here for, is to take that stress away. We're the professionals, and we're going to guide you and help you get through that process. Jacob talked about the bidding process and having that pre-qualification / pre-approval. It's so very important when we're bidding and we get into the submitting the offers, because the sellers are going to want to know who they're dealing with, and they want to know that whoever is making an offer is serious and qualified, because they don't want their time wasted when they're trying to sell their house, because it's a stressful time for them as well. They're trying to get a house sold, and they want to know they're dealing with serious people. So, and then we're going to talk about, what it's like to negotiate with sellers and the 3 points that are going to go along with that. So any questions, so far, just post a comment. If you've got anything that we've talked about so far that you've got a question about, don't forget, type in hashtag #MyNewHome2023 in the comment section to enter the gift card drawing. We love to do a giveaway, so make sure you get that in there, and it'll add it to the drawing. So if there's no questions, let's get into the negotiation point number 1. And that's the actual sales contract. So this is going to talk about the price that we're going to be offering. It's going to list out the closing date, any earnest option money that we're going to be offering, the kind of the standard agreements that go into what the offer is, and then any addendums and some of the more common addendums that you'll see in an initial offer contract. So let's take a look at that.
Sure.
So some of those you're going to see, it's going to be the residential buyer representation agreement. This is really an agreement between myself and the buyer, just stating and just showing that I'm authorized to represent you, that I'm going to be the sole person representing you. So this is just kind of laying out our terms as we partner up and work together. And then the main one that you're going to see is this 1-to-4 family residential contract. this is the big one. This is the offer contract that's going to go through. I know it's kind of small, so you might not be able to read it word for word, but we can do that on a one-on-one basis. This is really going to talk all the way through exactly what we're going to be offering for this home. So it's a detailed document. It's a promulgated document by Trex. So I'm not an attorney. I don't pretend to be an attorney or practice law. So this is really where we're going to go through and fill in the blanks. And this is what we would submit to the seller. So then next, this is a third-party financing addendum that's going to be attached to the 1-to-4 contract. And this is going to talk about the financing that you've obtained through Jacob. So again, I fill this out. It's going to talk about is going to be a conventional financing, a VA, USDA, FHA. So it's going to talk about all those things and kind of the terms that you've initially set up with Jacob. The next one on the right is a non-realty items addendum, and the example I usually use with this one is refrigerators. Everybody wants to know if there's a refrigerator in there. Does it come with the property? Does it not come with the property? So really anything in the property is negotiable. If that's something, if you see a desk in there or a table or lamp, and this is something that you would like to include in buying the home, this is where we would write that up. So pretty standard. They're all Trex approved and Trex generated documents, so which makes it nice and easy and universal here in Texas. So in the meantime, before we get into negotiation point number 2, are there any other questions or comments that you have? Please feel free to post them in your comments. We'll get those here and address those as best as we can. Please don't forget to type in #MyNewHome2023 in the comment section to enter for the gift card drawing. We would love to give that away. So make sure you type that in so you can go right into the drawing automatically. All right. So if there's no questions, comments,
no questions.
I don't think anything else has popped up. So I'll continue on to negotiation point number 2. And this is where a lot of new buyers aren't real sure what this process is. So there's an inspection that we're going to set up. Once the offer is accepted, we're going to go into what's called an option period. And this is where we get to do our due diligence on the buyer's side of the equation. So I'm going to help and get the inspection set up. And this inspection is for you. We're going to bring in a professional inspector. They do this for a living, and they're going to take a deep dive into this house because you want to know what you're getting into. So there's a couple of different kinds. There's the home inspection. Obviously, for the house, you can get a pest inspection done. If there's a pool, you can get pool inspections done. And what this is going to do, it's going to help expose any of the repairs that might need to take place, and really looking at the safety of the house, the structure, security of the home. So that's going to tell us really how the house is in regards to the shape that it's in. So this is going to allow us to negotiate any repairs or any cost in lieu of repairs at closing. This is really what this report's going to do for us. Now, to do that, we have to enter into the option period, which there's going to be a cost to that. So the option period usually ranges 3 to 7 days, depending on the property. And this is going to help protect your earnest money. So it's usually $100, $150, somewhere right around there. And you're basically paying for that time of the option period. So this is going to allow us the time for the inspection. It also puts a deadline on the negotiation. So at the end of that option period, whether it's 5, 7 days, we've got to come to terms with the seller on what we agree on. So that's, that again kind of puts pressure on the seller to make some decisions on what we're offering as far as after the inspection report. So it's gonna give us some time to reconsider. You can back out of that offer at this point in time without losing your earnest money. And we'll get into earnest money in a little bit. A lot of people don't know the difference between option and earnest money, but there is a big, big difference. But you're protected during the option period, and that earnest money that you've put up is protected as well. So it's an important period of time, not only to determine what the house is like and the condition and what you're getting into to make sure we're getting you the right home, but also protects you in the long run from making any big mistakes financially in something that you shouldn't be getting into.
Hey, Shane, I heard something recently on it, so maybe you can address too. On that, those inspection reports are pretty detailed, right?
Yes, very
So
detailed.
do buyers need to be concerned about everything that's put on that inspection
No,
report?
absolutely not. Great question. They can be scary to look at because it's an inspector's job to go in and list anything and everything that they possibly can. So I usually tell my buyers, don't get freaked out over an inspection report. There's going to be a lot of things in there just due to the age of the home. So track rules change every 2 years. Codes change for housing every 2 years. So if the house is older than 2 years, there's more than likely going to be some things that are out of code, which is fine. It just means that it's not up to the newest code. Doesn't mean it has to be redone or that it has to be brought up to code, but the inspectors do have to list everything in there. So there's a lot of points in an inspection report that can look scary and it can look daunting because it is going to be a sizable report. But that's why you have realtors in your corner to help walk you through each and every point and make sure that it's getting addressed the way it needs to get addressed.
And then one more question for you too. How much can a buyer expect to pay for that earnest money deposit? What are they looking at in the current market?
As a rule of thumb, there's no set amount. As a rule of thumb, it's about 1% of the offer. So if you're offering $200,000 on a home as the offer price, the earnest money, you can probably expect to ballpark it right around $2,000. This goes to the title company. It gets credited at close. So it's not something that you lose. It's earnest money showing good faith is basically what it is. Again, and that's protected during the option period. So if for whatever reason during that option period, you as the buyer decide to back out of the contract, you get that earnest money back. You don't get the option money back. So that $100 that you put up for that time to do your due diligence goes to the seller, but that $2,000 that you put up in earnest money is definitely protected.
So it sounds like a way that we're protecting both the seller and the buyer from wasting each other's time.
Yeah, absolutely. Yeah.
So now, So now that you've already, let's say you've already submitted your contract, you won the bid, and now we're going to talk about disclosures. So you submitted an application, I send it into the lender, and we generate what's called a loan estimate, which just kind of gives you kind of a rough estimate of the breakdown of several items. We're going to talk about each piece of that, right? So the disclosures include your loan estimate, first of all, a couple of items that help protect you to make sure you're not being taken advantage of, right? An anti-steering, which means, just so you know, ever since the debacle with 2008, loan officers are not allowed to take advantage of you based on the interest rate. And so anti-steering helps us stay clear of that, right? We're not trying to steer you towards one rate or the other. We may advise you on pros and cons, but we're not getting paid for giving you a higher interest rate. We're just advising you, right? So the anti-steering is to protect you from being taken advantage of. And then, of course, privacy. Nobody wants to share your information with unwanted people. And so privacy policy protects you as well. There's some other agreements between, the company or whatever company you're dealing with and you. And then, of course, the intent to proceed. And that just means, okay, I've seen this loan package, and as it stands, I'm still interested. You can still back out, but you intend to proceed with the loan. And those documents, the loan estimate breaks down a couple of things for you. And it's kind of hard to see, I apologize. But so basically, I'm going to go back to the last slide, actually. The loan estimate's going to give you your loan amount. See that top, that loan amount, the interest rate, and then about what your monthly interest and principal. Notice this does not include the insurance and taxes, right? This is just how much the loan amount costs plus the accrued interest. Okay, and then they'll kind of have a breakdown of what are your estimated taxes and insurance in the middle there, and then also, how much do we think you'll pay in closing costs? How much do we think we'll need to bring to the table to close on this loan? Right, that's the first page basically. Your second page is going to kind of break down all the different items that are involved in closing costs. So even some people are really confused about this item too. So there's some programs where you don't have to pay any down payment. So VA and USDA, and then of course there's some that have a down payment assistance where you don't have to pay a down payment, but you always have to be concerned about closing costs. Somebody has to pay those, and that's typically between the buyers and sometimes negotiating with sellers, which we'll talk about later as well. But there's a breakdown of all the different fees. And when you're comparing lenders, which you don't need to compare anybody besides me, I'm just going to say that right now. But when you're comparing lenders, you want to look at this box A right here. This is where the origination for your loan officer is going to come from. It may have an underwriting fee, it may have points or lender credits here, but basically if there's an origination fee, that's what the loan officer is making. And there are other ways we can talk about compensation, but I'm not going to get into that in this presentation. Which gets us to our next item.
So we've gotten through the process. So we've gone through the first two, the initial offer, and then we've gotten through the option period. So now we're past the option period, and now we get into the negotiation point number 3, which is the appraisal, which is a lot different than the inspection. So the appraisal it's a lender appraisal. So this is going to be for the lender. They want to know exactly what they're lending their money on, and that the value of the home that they're lending on meets what the money that they're giving you to buy it is. So this is for the lender. It's going to help determine the value and the safety of the home. It's going to determine if there's a cost and turn times that are going to vary in the process. So usually a loan is going to be about a 30-day closing period. It can be a little shorter, it can be a longer, just depending on what kind of loan we're talking about and how it's structured. This appraisal is paid for upfront by the buyer. So this is going to be your report, but it's for your lender. So it is scheduled through the seller's agent. So we would get with the lender would get with the seller and get this scheduled. So they're going to send out their own appraiser to determine the value on this home, because they want to make sure that the money that they're putting out meets what we offered. So where it becomes a negotiation point, if you want to go to the next slide.
Yes,
I'm sorry. One more back.
Okay.
I'm sorry. So where this becomes a negotiation point is if the appraisal and the offer don't match up, somebody's going to have to make a move, right? So the lender's only going to lend money up to what's appraised for. So if we're off by $5,000 versus what we offered, then either one, the seller can come down to meet that number. 2, the buyer can come up to meet the difference, or the buyer and seller can negotiate and meet in the middle. Say you take $2,500 off the price, I'll put in $2,500 more in cash, and we'll make it work. The last point of that, which is the one nobody really wants to talk about, is the fact that we can agree on it and we walk away from the deal. Right. But why that's important is because this is an appraisal and it's based on the lender and the value, your earnest money is still protected. So you still have the ability to walk away at this point because of the appraisal. If we can't negotiate the deal at this point, your earnest money is still protected at that point. So a lot of people don't realize that, and they get freaked out like, well, what if the appraisal doesn't match up? Am I going to lose this money? No, you're protected because this was a lender appraisal and nothing that you determined yourself. So that's where you're protected on that point. The other thing in the last bullet point is it's based on comparable sales for the most part. So the appraiser is going to go look at the property. They're going to do a physical inspection, do a walkthrough, and they're gonna look at the surrounding comparable sales and see if what we've offered and everything and the value of the home is meeting with what the market is saying the appraisal should be. So that's going to be based on the comparable sales from around the home within the last 6 months.
I want to add a couple of things to that, Shane. The cost and turn times. So a couple of things about the cost and turn times, right? How busy is the appraisal company, or how busy is the appraiser who's going to accept the job? And that can determine the cost. Like when we had the refi boom, there were so many requests for appraisals that costs skyrocketed, right? In this current market, you can probably bet between $500 to $800 on an appraisal. That's pretty reasonable. And turn times right now, in at least in our area, I think they're between 7 to 10 days, and depending on who it is, sometimes they get it back faster. But a reasonable amount is about 7 to 10 days. The other thing that might change the turn time is if you live out in a remote area, appraisers have to schedule, that make their trips count, right? So they may wait till they get a few appraisals out in that same area and then do them then. And so that sometimes that can affect turn times as well. The other thing about the appraisal I wanted to say too, Shane, is, when the good thing is this is for you as a buyer.
Yeah.
The seller never sees it. And so the only people that need to know the information that's on the appraisal, unless it's below, is you, your realtor, your lender, and the appraiser, right? And so the good thing about that is if the appraisal comes in above the sales price, that means that you already have equity in the house and you're actually paying less than what the house is worth. So that works in your favor. And typically, when all you need to say is, as long as the appraisal says as is and gives you a value that's at least at that value of the sales price, you're good to go. It's when it's below or doesn't say as is that we have problems. So,
yeah, it's a great point, Jacob. I mean, when an appraisal comes in and it's higher than what we offered, that means we did a really good job on negotiation number one. So anytime you can get into a house and you've got instant equity, that's a good feeling for sure.
Yeah. All right, I'm going to stop for questions. Do we have any questions before we go on to the next point? Oh, that's not it. Sorry.
Yeah, and then make sure if you want to get on the gift card drawing, make sure you type in hashtag #MyNewHome2023 into the comment section. You'll be automatically entered into the drawing. So make sure you type that in there. We would love to get something away. There's a QR code up at the top. Feel free to please sign into our guest book. And then also that's a spot you can go to give us some feedback after the presentation as well.
Absolutely. Yeah, we definitely want to keep getting better at this. So if there's stuff that you're like, hey, can you address this question, and we didn't get to it, we're happy to do that. So
yeah, absolutely.
All right, so I don't see any questions. Let's go and move on to the next one. So after we've gotten through all of that, after we've agreed we're going to finish this loan, right? Then it's on us as the buyer and the lender to meet our end of the bargain, right? And so I want to talk about, I added this from our last one, Shane, but you want to think about you as a buyer, the lender, and the property all as kind of a three-piece partnership, right? Or company, right? An investor wants to know that you're qualified and the property is qualified, right? You want to know that the investor is going to back you, right? And that the property is going to be, sustainable, right? And so all of this kind of plays together. So this is all really, it is a partnership because you're requesting funds from an investor, from a lender, and they're trusting you that you're going to pay your note on time. So all of this paperwork is all about that trust, right? Building that trust. We've established this relationship and we're going to continue this relationship. So think about it like that. So underwriting conditions, basically an underwriter is somebody who works for a lender who evaluates the risk factors and make sure that they meet all the requirements from whatever guideline the program calls for, right? So the most common ones are just things that need to be what we call cleared, which the appraisal. Does the home meet the value of the sales price? Or have we made an agreement to where we can resolve that, right? So that's the appraisal. Now, there's a couple of things about we're going to call them cool down triggers, that we cannot actually close on the loan until 3 days have passed on 2 items. The first one's the appraisal. Once we get the appraisal back, we want to make sure, you know, that we have time to review the appraisal, that we agree with the appraisal, that we still want to continue forward with the appraisal, or negotiate whatever we need to do. So that gives you an option, again, to back out, like we talked about from the negotiation point, right? Then there's the title work, and title is important because you want to know that when you purchase this house, it's really going to belong to you and not some Joe Schmo who in the past had some sort of lien on it and still can claim it, right? So the title company is going to, just like on a car, you want to make sure that you have a clean title, that nobody else can claim that car but you when you buy it. Same thing for a home. They're going to evaluate what's called the chain of title, making sure that it can go, you know, they can trace it back all the way to make sure nobody else can claim it. Then they're going to have insurance to protect that chain of title, and they're going to issue a protection letter, which again seals that agreement between the title company and the lender that yes, this is free and clear. It will totally belong to this buyer once we actually complete the deal, right? Insurance. You need to have insurance on this home before they'll close, because I want to make sure, again, another piece of this is insuring the investment. And so we highly encourage you every year to shop insurance, make sure you're getting the best rates and the best products. And you can do that every year. And then, of course, you know, you shop insurance companies, you have somebody you like that's great. You choose the products, you choose the package that you want, and then we do something that's called binding it. Basically, we bind is an agreement between the lender and the insurance company that's who is claiming that loan or that lien. They want to make sure that the income and employment that you've submitted is accurate. They're going to verify that with your employers, and they want to make sure that your employment is not only stable but is going to continue. And so that's important. Sometimes there's things called credit supplements where, let's say, we need to update this report to show that your payments are current on a certain account, and so they'll order what's called a credit supplement. They're they're rare, but they happen, right? Letters of explanation are pretty common, and the most common one for that is whenever you pull a credit report. Sometimes you may have, like, for instance, women maybe have a maiden name before they got married, and now they're married and have multiple names on record. Through various, companies, right? So usually what you'll do is you'll sign what's called an AKA, or as known as, right? I used to be known as so-and-so, now I got married and my last name is different, right? Things like that, or nicknames, or any other name that has appeared differently. Different addresses that appear on that, you may just have to explain why they showed up if they're not on your housing history. And then any inquiries, if you've applied for credit or somebody's pulled your credit, they want to know why and make sure you're not entering in another loan before you get this major loan, right? Which is very important during this whole process. Don't do anything else with loans. Don't get any type of other loans, credit cards, anything. I know you want to furbish that house with Home Depot stuff, but you got to wait. So just remember that. And then the closing disclosure, which is like the loan estimate, but it is more fine-tuned. The numbers are going to be pretty close to what it should be for all of the interest rate will be locked in. Your closing costs should be pretty close, depending on just making sure we close on time, but it should be pretty close at that point. And then after that's been issued, you still have the option to back out. Again, to protect you from being taken advantage of, you get that 3 days to kind of look at the closing disclosure, get over that initial shock, and then like, okay, we're doing this, we're good, right? So that protects you. So, and then we get the clear to close. We met all the conditions. That's what all realtors and all buyers love, and lenders, obviously, but they love to hear. Clear to close. That's all I want to hear.
Three best words. Three best words ever. Yeah.
That's right. But this means that you're actually able to go to the title company, sign the documents, and finalize the paperwork, right? So clear to close means that that the lender has approved all of the conditions that they've asked for you, that all of the risk assessments that have been made, that you've met those requirements, right? Closing costs are finalized. We know how much we need to bring to close. Typically, that has to do with typically it's either a cashier's check or a wire. We may talk about that later. And then, of course, you get to schedule that time and day of closing, and it's usually depends on availability of you and the title company. Then we get to closing day.
Woo! It's a great day right here. So really what you want to do, I mean, this is obviously the excitement. There's been a lot of hard work on everybody's part, the buyer, the seller. So this is just a great day, but still the work's not done, right? We've gotten to closing day.
Oh, sorry.
Usually this is going to be at the title office. It can be mobile if you're coming from out of town or out of state. I had one not too long ago that was they were coming from California. They signed there. They were buying in Dallas. So it can happen virtually or with the mobile notary, but typically it's at the title office that we're doing the closing at. You really need to make sure you bring your IDs. They're going to want to see those IDs so they know who's actually signing the documents. Cashier's check or wire is what's going to be required. They're going to let you know ahead of time what the total amount's going to be. It's going to be on that paperwork that Jacob was talking about. And I'll let him talk here in just a second about what can happen with the wire fraud and all that. We're going to get all the paperwork signed. I, as your realtor, am going to be there if we're doing it local title company. I want to be right there by your side in case you have any final questions about any of the paperwork that you're signing. And then we're going to celebrate. But I do want to jump back and let Jacob talk about the point about the actual funding of what's going on.
And just so you know, too, like if it's local, I'll be there too, because if I can, I'll be there. So we're gonna celebrate all this together. We've been through a lot together. You've shared all this personal information with me. You may not have shared with somebody else in your life. So we're gonna do this together. That being said, because we're dealing with money, wire fraud is an actual problem. So it's very important on the day that you decide to wire your to closing, to title, for closing costs. That number one, you communicate with the title company, tell them that you're going to send it, and follow their instructions to the T. If you miss something, they may not see it, or they may not, they may say, well, it wasn't put in right or something, and they may not know who to apply it to. So that's the important thing about wiring is accuracy is important. It is the easiest way to transfer funds to pay for closing costs, but it's cashier's check works as well. As if that scares you, then cashier's check is fine too. It's just wiring is so much easier. So, but because it's easier, it's prone to fraud. Mm-hmm. So, but yeah, and I will be there too to help answer questions about paperwork. And if it's not local, I'll be on standby to answer questions too. So,
absolutely.
So I think it's a good time.
And then we get to celebrate. Yeah,
that's right. Yeah, we're gonna take pictures. We're gonna take you out for food, whatever.
Whatever. So, yeah.
Any questions at this point? This is kind of we just start with walking you through the whole process. We still have more to go, but I wanted to give you an opportunity to, again, fill out our QR code. It's our guest book, plus you can ask questions, give us feedback there, or you can enter in comments into the comment section, and we'll get them here as well. But if you want to enter for that $100 gift card, type in hashtag #MyNewHome2023, because we're going to get you a home in 2023, right?
Love it. Yes.
Add it to the comments, and we'll enter you in for that drawing. I'm going to go and leave that up, Shane. I'm going to and just keep going if that's okay with you.
Yeah, perfect.
Okay, cool. So if it covers up the information, I apologize, but I only guys give you a. Oh, we got a good question. I'll let you answer that one, Shane.
Okay, I'll take this one. So somebody just asked the question. Great question. When can the buyer occupy the property after closing? So really two things. So once we've closed, that's one thing, but it also has to fund. So once it's been closed and funded, then it becomes the property of the buyer. There are instances where the seller asks for what's called a lease back. So they may need a little bit more time to get out, like a couple of days after closing, just to do some final packing up and get out. So that's negotiated in the front end in that offer contract. So that's all decided well ahead of close. But typically, once it's closed and funded, it's yours. You get the keys. Until funding is cleared, it's still the seller's house. So we usually do a final walkthrough the day before closing, just to make sure everything is the way it was when we did the inspection, put the offer, and all that kind of good stuff. But yeah, great question. You don't get to start occupying the home until it's closed and funded. So
Right.
great question. Thank you very much.
And I'll touch on that, Shane, too, because sometimes it happens, right, where you the only time you can make it to go sign is going to be, end of the day, 4 o'clock, 5 o'clock, right? And let's say your lender maybe closes sooner, right? So you may sign the documentation, but they're not able to send over the funds until after it's signed, right? So let's say you sign at the end of day on a Thursday, you may not be able to take ownership until Friday if it's at the end of the day. That happens too. And is that legal? Is that a legal thing, Shane?
Because I think there's been instances in the past, and I think that's probably why they put this in,
Yeah.
where it closed, but all of a sudden something happened and the funding didn't go through. People take possession of the house, and then who at that point in time really owns the house, right? So
Right.
I think they really tried to make it clear, and this was several years ago. Really tried to make it clear on, closing on the house is one thing, but it's got to be funded. So it's got to be, that financial transaction has to have been completed.
Yeah. Good
Great question.
Thank you, Mindy. All right. I'm going to keep going, but feel free to ask questions. We'll just stop at this one. We'll just stop if there's questions, but we're going to answer some of those top questions of what first-time home buyers wish they would have asked before they bought, right?
Mm-hmm.
So how do I know I'm getting the best rate, right? That's a really great question. And unfortunately, there's not really a short answer to this, right? It depends on several things, right? And you need to know that. Not all rates are created equal, but you can shop around and find competitive rates. And the way that rates are structured, depends from lender to lender. There's, typically it's pretty close, but there are variances depending on the way that a lender will structure their all the way they deal with their the cost of the loan itself. So something else to know too is if you get a fee worksheet from a lender, that is not an official quote. That is not determined. That is not official unless you have a loan estimate. It shows you all the costs. It is not an official quote, just so you know. And I give out fee worksheets just so a buyer can kind of prepare for, like, what am I looking at? Closing costs. What would my payment be if this were that? And I provide that all the time. But I'm very clear that that's not a locked-in rate. That's not including more accurate title fees or escrow, or I can get pretty close, but it really is important for you to ask for a loan estimate while you're shopping around. That's critical.
Yeah.
So here's what determines your rate, right? By the way, I know that's a meme, but we do have lenders at Nexa Mortgage that will go down to a 500 credit score. Of course, that also depends on what's in your history, right? Yeah. So by the way, let me pause real quick to talk about credit, because that's really important. Your credit is more than your score, right? So you may have a 620 score and you can qualify for a conventional loan, but if there are any late payments on that credit report, you may not pass what's called underwriting. It may flag it and say, no, this is not going to meet requirements because you have late payments. So don't look at just the credit score. Look at, what is my payment history? Do I have any late payments past 30 days? That's really what we want to look at. So here's what determines your rate, right? Loan type: conventional, FHA, and VA, USDA, and non-QM all have different rate structures. And each one of those loans has a different investor market. So you need to understand that investors kind of determine that too. The property itself, what kind of property is it? Is it a mobile home? Is it just a regular stick-built home? Is it a barn-dominium? It just depends on what the property type is, right? What is your credit? What is your debt-to-income ratio? If you have a high debt-to-income ratio, you may have to go with an FHA versus a conventional. You may have the money for it, but you have to go because your debt-to-income is too high. Assets: how much do you have to close? And some of this also plays into underwriting, not just the rates, but the underwriting. So if you have, let's say you have a little bit of bad credit, but you have a lot of cash, that's called a compensating factor. And that can kind of offset some of the things with maybe a lower credit score. And so the underwriting system has an algorithm based on those risk factors. If you have a compensating factor, it may overcome that and get an approval where you might not have otherwise thought it's possible. And then rate lock term. You can lock a interest rate, which secures that rate even though the market's still shifting. Once you lock that rate, it's guaranteed for that number of days. 15, 30, 45, 60, 90. There's all sorts of rates you can lock at, right? And it usually 15 days is cheaper, but today I locked one that was cheaper at 45 days. It kind of blew my mind.
Wow.
So it just depends, right? And then
That's
points
awesome.
and fees. So points, discount points, or other fees that go into that can also determine your rate, right? So if I wanted to get a lower rate, it may cost me a little bit more money. Those are called discount points. Yeah, just fire away at questions, by the way. This point, we're just kind of going common questions, but you guys fire away. So what is included in my monthly mortgage payment? This is kind of important to know. So principal, that is basically the exact amount of money that you're borrowing. If I'm borrowing $100,000, then I'm going to take whatever that term is, let's say 30 years. I'm going to take $100,000, divide it by 360 months payments, and that's my principal payment. The interest is what is the interest rate that is applied to that principal amount over the course of those 30 years, or they take it a year at a time, right? And then your insurance, and I'm going to make a differentiation here, right? Homeowners insurance or hazard insurance is what they call it too. That goes into what's called an escrow or holding account, along with the taxes, which I've skipped. I'm sorry, but the insurance can also be affected by your credit score. By the way, like if you have good credit, you may get a better pricing on your insurance. But also the property type. If you have a different type of shingle, that could make your insurance go higher. So you need to know that could affect your debt to income as well. So when you're looking at a house, it's really important to ask about the features, which Shane can absolutely help you with. But insurance is part of that payment. Taxes, what are the property taxes for your area? And you can go to your local county appraisal district and look up any property, and it'll tell you what their tax bill was for the past year or what the tax is for the current year. And it'll give you, and you just divide that by 12, and that goes into your monthly payment. So your basic payment is PITI, or principal, interest, taxes, and insurance. Now, that's your basic payment. Part of that I, or that insurance, is also if you do an FHA loan, or if you do conventional with less than 20% down payment, you pay what's called mortgage insurance. It just kind of guarantees it's another safeguard for the lender not to lose money in case something happens and you can't pay the mortgage, right? Mm-hmm. So mortgage insurance covers that as well. That is added to your monthly payment. So that kind of goes in the same category as hazard insurance, but it is a different type of insurance. So principal, interest, taxes, and both types of insurance. And then sometimes some people don't think about this, but if you have a homeowners association, sometimes they'll have dues that go along with that. And those are often split into 12 payments for the month, or for the year, excuse me. Yeah. And they are added to you. Those count towards your debt to income. So you need to know that as well. If you're looking for a house and you notice it's in a homeowners association, just keep that in mind when you're looking at price points.
Yeah, it's a great point.
Yeah. Yeah, jump in anytime too, Shane.
Any other questions? Anybody have anything? Don't forget to type in hashtag #MyNewHome 2023 for the drawing.
Yeah.
$100 gift card.
All right. What are closing costs? Again, we talked about down payment, right? There are some zero down payment programs, but there are always closing costs that someone has to pay for, no matter what, right? So what are closing costs? These are expenses that go beyond the purchase price, the cost of the loan, the down payment, all those things, right? So those are usually at the tail end of the deal, right? And you don't pay those until we get to the closing table, but they are estimated in your, in your loan estimate and your closing disclosures. But these include fees from the lender. So you may have an underwriting fee, discount points, an origination charge if you choose to go that route, but also fees from the attorney, like preparing the documents to sign. They're just like a third-party attorney that has no interest in the deal at all. and they just keep it legal. And then whatever the title and escrow company have to do the title searches, to set up your escrow account, which we'll talk about in a little bit later, the property taxes and the insurance. Those all go into what's the closing cost. Again, all loans have closing costs regardless. Somebody has to pay them. Excuse me. And lenders must give you a detailed estimate of these fees. That goes on that loan estimate I was telling you about. These can be paid for. The closing costs can be paid for by you as the buyer, but you can also negotiate with the seller or the builder, depending on the scenario. They can contribute. And depending on the loan type, there's a maximum amount they're allowed to contribute, right? So for example, a VA loan, they can only contribute up to 4% in help. With conventional, they can go up higher, but it also depends on how much money you're putting down. So there's a chart I can provide if you're interested in that as well. Excuse me, losing my voice here. And then of course, if you have gift funds or lender credits, those go on that as well, but those go towards paying those, right? So if you need help with closing costs, hey, mom or dad, can you give me some gift funds? These cannot be borrowed, they must be given. That's hence the word gift, right? No expectation of repayment, but those can go towards helping you with your closing costs. And then lender credits. Let's say that you get a good interest rate, but you could pay more if you needed to, right? So let's say you get a 5% interest rate, but if I go a little bit higher, let's say 5.25, I may get like $1,000 worth of lender credits. That will bring my closing costs down. So those are called lender credits. You can pay a little bit higher for interest rate to get cash up front. That sometimes that's better than if you don't need a whole lot of help. So I go there first before I offer down payment assistance counseling personally.
So I got a question for you, Jacob.
Yeah.
So, because I know buyers are, in the market that we're in now, it's shifted obviously from what it was a year or two ago, where it
Right.
seemed like sellers were in complete control of everything. And now that buyers have gained a little bit of leverage back, are you seeing more contributions from sellers or builders towards closing costs?
Yes, absolutely. And some of that we talked about, like the inspection, the appraisal. Sometimes that comes up before we even talk about, or that'll come along in the process, even if you don't negotiate in the sales contract. That when you're talking about negotiations, right? So something comes up, and so let's say the inspection brings back something that may not pass appraisal. So that's another reason why inspection is important. They're not required, but they're very highly recommended in some cases, right?
Mm-hmm.
But let's say you have an exposed wire that's a safety issue. The sellers have to fix that, or the lender won't move forward on it, right? So some of those are by necessity, obviously.
Yeah,
but
that's certainly, I see that a lot on VA loans because it's,
yes,
there's a few extra hoops on the VA loans. It's a great program, but they certainly look at things at a deeper level. Yeah.
right. All the government loans, so like FHA, VA, and USD are going to have a little bit more different guidelines than conventional, for sure.
Yeah.
But yeah, to answer your question though, like closing costs, sellers are more willing to, offer more closing costs, and a really good, and you can either rebut this or support this, but say that that the property is probably going to appraise for more than what it's listed. You're pretty confident in that, so maybe you offer $5,000 higher on purchase price, confident that those are that the appraisal should come in higher. Maybe it's just been on the market longer and they just want to get rid of it, right?
Mm-hmm.
And so you offer a little higher and ask for that $5,000 back towards cash.
Yep.
So it kind of gives them a little bit of an edge on, I'll still get that sales price in the long run, but we know it may appraise for higher, right? Now the danger with that is you have to make sure it does appraise. Otherwise you have to renegotiate. So
right. Yeah. Good point. Very good point.
Yeah.
Yeah. And I'm seeing a lot of, especially with new builds, new construction, some of the builders now, because their inventory levels have creeped up,
mm-hmm.
And they're not selling them as fast as they were, or offering a lot of incentives. And some of those incentives are buying down points.
Yeah. I was going to talk about that next. Actually,
yeah. So that may be something to touch on there, because I'm seeing a lot of that where, either they're offering, a bunch of appliances or money towards clothes, or money towards helping buy points down because everybody's been, fearful of the interest rates that have gone up in the last,
Right.
12 months or so.
Right. Well, and I'm going to say 2 points on that, Shane, because I think it's sort of important. So a buy down is similar to, it looks like what's buying points, but it's not the same, because you're still getting qualified at that interest rate. And I'll explain what that is. So let's say you qualify for a 5% interest rate, and that's what we're closing the loan on, right? So I'm going to do a 2-1 buy down, which means I'm going to go 2 years out, and I'm going to year one, I'm going to pay down 2 points or 2 interest rate percentage points, right? So for the first year, I'll pay 2%. The second year, I'll pay 3%. I cannot do my math right. The first year, I'll do 3%. The second year, I'll do 4%. And then at the third year, I'll be paying at the rate of 5%. So it gives you some time to kind of ease into that payment as well. You're still being qualified at that 5% because you have to be able to show that you can repay that. But that works really good. If you have the money to close, you don't need help. But like, hey, if you're willing to do this, help us with this interest rate, right? So it's also not points, but it's basically it's cash that's put into a fund that is paying the difference to the lender. So it's not the same as discount points per se, but it operates very similar.
Yeah.
Yeah, definitely. Buy downs are kind of a good selling point right now. So.
Yep, absolutely.
And the other thing I'll say is, on average, the life of a loan, whether you sell it, refinance it, or whatever, is 5 to 7 years. And so if you think about that, like, oh, the interest rates are this, right? Well, in 5 to 7 years, a lot can happen. And within that time period, rates are likely to at least get to maybe a better point.
Sure.
They haven't been horrible since the 80s, right?
Right.
So,
Right. Yeah.
Even interest rates we're at right now are not horrible. They're as convenient as when we were getting help. So
yeah, I mean, I think the 30-year average is right around 7.3%. So
yeah,
we're even under the 30-year average right now, and we have been. So
right.
they're not crazy. They're higher than the historical lows that we just went through, which is not really a common number that we've seen in the down that low. But where we're sitting right now and that's why we opened up by saying this is still a good time to buy, because interest rates are still good,
right,
historically. So
absolutely,
it's still a great time to buy.
Right. And now, like you said, like if you have the cash to buy, or if you're qualified to buy and you can make it work for a short period of time, maybe 6 months to a year, or at least a year probably, and then you can refinance later. Jump in now. It's
Sure.
great. That way you're building the equity and put you in a better position. The other thing you need to know about mortgage is nothing can positively affect your credit score than paying a mortgage on time. Nothing boosts your credit like that. So something else to remember.
Yeah, great point.
Please keep firing questions away. We'll stop and answer them if you guys put them in the comments.
Yeah, absolutely.
So what is an escrow account? Excuse me. This is an account that is established by the borrower with the lender that pays your property insurance, your taxes, and of course your payment in general. For the course of the year, it can change every year, but basically, if you take 1/12 of your annual insurance and your annual taxes, put that into your monthly payment, that's your escrow account, right? Or that goes into your escrow account, and you save it up. That way, you're not paying one lump sum at the end of the year, right? And then you're like, oh no, I don't have this much money. Well, you've been paying it every month, and so that helps protect you. Now, something to note about both taxes and insurance is that they do change all the time. So every year, you want to get a new quote on your insurance, see if you can get a better quote. It is kind of important to note that insurance rates have gone up this year, so that may be something to consider as well. But taxes taxes also are not evaluated the same way as a tax appraisal is not the same as a market appraisal, right? When you pay for your appraisal, that's not what you're paying taxes on. You're paying on a tax assessor to kind of look at what is the tax value, and it's typically a lot lower. So that works in your favor as well. Excuse me. So the escrow account pays your bill, and it usually changes annually. And of course, we encourage you to shop insurance. You can't do anything about the taxes, unfortunately.
Right.
Except you can file for homestead, which takes about a chunk away from what they tax. So that's something also to note. All right, what is mortgage insurance and why do I need it, right? Well, mortgage insurance protects the lender if you fail to pay your mortgage. So it used to be people would put down a lot more money for houses when they weren't, this expensive. When houses weren't in the several $100,000 range, people would traditionally put more money down, and it's not needing, mortgage insurance. Well, when people had a hard time paying and some fell through, like, well, how can we recoup from this? Well, the mortgage insurance came in to kind of fill in the gap. It's similar to what gap insurance does for like a car payment,
Mm-hmm.
right? So that's there to protect you and your property. The homeowner's insurance is there for you and the property. Mortgage insurance is there for the lender, right? It is important to note that FHA loans require insurance, mortgage insurance, the entire life of the loan. No matter how much money you put down on the loan, it's going to go for the entire time. With conventional, once you hit that 80%, which means 20% down, the mortgage insurance is no longer required. And it kind of has an incremental step depending on how much you put down. So for conventional, if you're a first-time home buyer, you can get into a house with as little as 3% down. FHA, you can get as little as 3.5% down. But a conventional, if you're a first-time home buyer, 3% down. Just note that mortgage insurance will be required, and it's typically going to be a higher premium than it would be if you put 10% down. It's just, again, it has to do with the risk, right? Greater risk to the lender, the higher the interest rate or the higher the cost. That's just the way it is.
Yep.
The lower the risk, the better your rate and cost you're going to get. So just keep that in mind too as you're looking at products. So anyway, conventional loans have mortgage insurance until you meet that 80% of the loan to the value of the home. And of course, it depends on how much you put down. And then there are several mortgage insurance providers, and some lenders actually kind of offer their own premiums depending on how large they are. So that's something to consider too.
So, and Jacob, on the conventional, so say somebody puts 5% down and they've been making their payments and they finally get, 20% equity into the house.
Yeah.
Does that automatically drop off, or
good question.
They have to file something, or?
Good question. Yes, you must, once you know that you're at the 80%, you must request it. However, legally, they cannot continue collecting mortgage insurance once it hits 78%. So if you're keeping tabs on your payment schedule and you know it hits 80%, immediately file that paperwork, and they'll drop the mortgage insurance. But if you happen to forget, because that's that could be a long time, you may forget about it. They're required to drop it at 78%. So that protects you too. So good question.
Good stuff.
What are discount points? We kind of already discussed this, but basically fees that are paid to the lender. So paying more to the lender to get a reduced interest rate. So I want a lower interest rate, I got to pay for it. It's also referred to as buying down the rate. And when you get it, let me say this too. Some lenders will try to be more competitive by saying, oh yeah, we can get you at 5%. Yeah, but you need to ask them, how much does that cost in discount points? Which is also why I say it's important not to get a fee worksheet, but to get a loan estimate, because they have to disclose that. If it includes any points at all, they have to disclose that. And so you may not be getting the rate you think you're getting. So it's very important to ask up front, say if you're shopping for rates, which you don't need to shop much longer if you just ask me, but I'll be upfront with you about if there are any points involved, right? But you always need to ask the lender, does that include any points? And then credits are the opposite idea, right? If I just need some more cash help, yeah, sure, I'll leverage a higher interest rate if you can give me some cash back to help with my closing costs, right? This is also called a rebate. So, yeah, again, jump in with any questions. And again, please enter that hashtag #MyNewHome2023, and please fill out our form. We want to know how to get better at this. So,
yeah, we love the feedback.
All right. This is how
close. Finish line.
Yeah. Shane, why don't you talk about some doozies you've seen before we actually talk about the do's? Let's talk about some crazy do nots.
Yeah. So, always be honest and upfront. So, and we kind of touched on this just a little bit ago. Um, it's going to save everybody a whole lot of time if you're completely transparent with everything that's going on in your financial world or employment world or anything like that. Nothing's worse than trying to get this thing to the finish line and getting that close, and then finding out, a detail about employment or a detail about something financial that pops up. It really can be discouraging for everybody involved that's put in a lot of time and effort, from the buyer to the seller to everybody involved. So it's always the best to be completely upfront, honest, transparent from the very beginning. We're trustworthy people. We kind of have an oath that we have to keep. So it's important that you do that. So keep me as your realtor, Jacob as your loan officer, completely informed on anything and everything that's going on. And like it says in there, if you're unsure, just ask. Nothing harmful can come from that. Keep normal and more conservative spending habits. I try to set this tone almost from the get-go when I meet with a new potential buyer and we're going through all the ins and outs of the process, especially for first-time home buyers. If they're making a decision to buy the home and that's their goal, then all that other stuff, the Starbucks coffees and all those things, those are secondary and those aren't important at the time. You need to start really curbing your spending habits, paying off debt, doing everything you can to get to the point where you're qualifying for the type of home that you want.
Right.
Even after you get qualified, right, Jacob? It's
Yes,
I know you talked about, before closing, opening up that Home Depot credit card because you're so excited you want to go get that refrigerator, or that washer and dryer, and then all of a sudden that pops up on your credit.
Yeah.
And it throws everything off, and all of a sudden your debt to income is off now, and it just skews everything. So I try to be very upfront in the initial conversation with buyers about how this will impact down the road trying to get into a home.
Yeah, something that's kind of a joke between realtors and loan officers is, yeah, when your buyer drives up in their new car, you're like, whoa, wait. But seriously, two things on that. It's important to know that when you sign documentation, you are also throughout the loan process attesting to the fact that you are not taking on more debt. Because if you do take on more debt, you have to disclose it. And in not every case will it disqualify you, but you're playing with fire, right? And the second thing I was gonna say is there are times where it's a necessity, right? My car broke down and it's not going to work anymore, right? My monthly payment was $400, right? But if you get another car that's $400, and we're talking about it, we talked to the lender about it, the underwriter, and they know about it. We're disclosing everything, and your payment's not changing, or if it does, it shouldn't change much. You don't want to play with the DTI at all, your debt to income at all, right? But things do happen, and that has happened to me, and we've made it fine because they disclosed it to me, because we made sure it was an equal payment or pretty close to it, and it wasn't affecting their ability to fund the loan. So that does happen, but definitely don't plan on that for sure.
No.
Because you keep this in mind too. When you sign those papers, you're attesting to the fact that you're not taking on any more new debt. And if you sign that at the closing table and you brought up your new car, you just committed fraud. And that's even more serious than not getting a loan.
So that's scary. Yeah.
So
it goes back to that: be upfront, be honest. If you have any doubts, just ask.
Yeah, absolutely.
Yeah.
Speaking of, here's how to get your loan denied. Don't change jobs. Don't quit jobs, right? Don't buy a vehicle. Don't get behind on your payments. That's very important too. Because if you you've made it on time that whole time, and all of a sudden you stop paying your rent and they kick you out, that's going to look bad on you, right? Yeah. Don't change bank accounts. It just looks suspicious. And of course, we're looking for, ever since 9/11 and 2008 happened, they're looking for anti-money laundering practices, because that was part of the issue in the real estate market was money laundering and sidestepping, legal process, right? Do not apply for a new credit. This includes co-signing. Say, I'm not planning on paying it, but basically, guess what? When you co-sign for somebody else, whether it's your brother, your mom, your dad, doesn't matter, it shows up on your credit report, and it is a new debt, because if they fail to pay, guess who they're coming to? They're coming to you, right? So don't bet on that. Make sure that you're only signing for the things that you're responsible for, or that it's already been disclosed again. So any large bank transactions, they need to be sourced. So like you say, all of a sudden you have a $50,000 deposit. Again, anti-money laundering, they want to know that it's, being legally sourced and not, trafficked somewhere else, from somewhere else. So just keep that in mind too. So
yeah.
I have to give a funny story.
And a lot of people have, not a lot, but it's happened where, a mom, dad, brother, sister, friend, whatever's, giving somebody, $5,000 or $10,000 to help them towards their house. And it's got to be explained. It can't, it's got to be a gift. I think you talked about that before.
Yeah.
But a large deposit like that shows up, they're going to want to know what it is. And is it another loan? Did your brother-in-law loan you money? They want to know when they see that on there, and they're going to be looking.
Right. And let me say this too. A lot of people talk about mattress money, which is, kind of figurative, but also literal in some cases. If you've just got cash in a savings, like your safe deposit box, and all of a sudden you deposit it, it has to sit there until it's called seasoned, right? They want to know that it's legit and it's not just money that's going pass through, right? So they'll probably all ask you, where did the money come from? And of course, we need to wait 30 days for it to sit. So that can also delay your closing if that happens. Or they won't let you use that money in any case. So just keep that in mind. We want to give a big shout out. Thank you, by the way, for coming.
Yes, thanks, United Wholesale.
Our sponsor, United Wholesale Mortgage. It's one of our biggest lenders partners at Nexa Mortgage. And just get a shout out to my friend DeMarco, who made all this possible as well.
Thanks, DeMarco.
Yeah, thanks, DeMarco. So I'm gonna. This is Q&A. I'm gonna skip this one because for other reasons, but we'd rather you scan this QR code up in the top right for this one, and don't forget to type in #MyNewHome2023 for that gift card drawing. But if you have questions, fire away. We'll be here for a little bit longer to answer questions if you need it. But we'll also leave this up here if you want to provide feedback or if you just want to just chat. So if you have questions, fire away in the chat. We'll see it in our chat box.
Yeah, absolutely. Yeah, we really appreciate everybody that's joined in and participated and thrown out some questions. And we would love to get the feedback. Again, We want to continue these types of educational seminars to kind of teach and show people that it's a great time to buy or sell down the road, whatever you got questions about. So really looking forward to that feedback and how we can improve. And if there's other subject matters dealing with real estates and lending and mortgage, we would love to, we'd love to know that.
And just so you know too, Shane is licensed in Texas and he operates here in the Lubbock area. But he can help you anywhere in Texas if you really needed to. And then I also am licensed in Texas and New Mexico, anywhere in the state. But if you are from a different state and you want to get help with a loan, I can't originate the loan or answer super specific questions, but I can definitely provide you with one of my colleagues who can take care of it for you. So.
Yeah. And same thing with Fathom. We operate all over the country. Mm-hmm. I've got some great agents that I've teamed up with, worked with across the country. So if you're moving or from Texas to Texas, we've got a good team in place that we can help you all the way around.
I'm not seeing any questions, Shane, but do you have any last points you think?
Yeah, I don't see any other questions. Said if you got any other questions, please scan the QR code. Yeah. Give some feedback, ask us some questions. Drop the hashtag in the comment section for the drawing. And we've enjoyed having a lot of people on.
Thank you for all who showed up. And this will also be available after the fact. But if you weren't attending live, sorry, that won't be the drawing will not be available. Sorry, but those of you attended live, it's definitely available. So
Yeah, absolutely.
well, I think we should just we'll go ahead and leave this up, and then
Yeah.
we'll duck out. If you have questions, feel free to ask. We can still hop in and answer, but we're just going to leave this up so you can provide your feedback, or if you have questions you don't want to ask in the comment section for other people to see, just scan that QR code, fill out your sign our guest book, and we really do want to know your feedback, like how we can make this better for you. If there's questions that we didn't answer, or just other questions or comments you have, happy to help. Please fill that out, and thank you for coming.
I appreciate you. Thanks, everybody.